This feature also leads to quick changes in the other direction. When times are tough, such as a major hurricane or earthquake that leads to industry losses, insurers and their capital backers pull back. This pullback of industry capacity was when Berkshire shone brightest. The year 1985 was one such year of tight capacity in which others, having suffered through years of losses, lost the ability or willingness to write new business. Berkshire, on the other hand, lived for such years. In 1985, Berkshire's insurance group wrote 372% more premium volume compared to 1984, and it earned 226% greater premiums. The winds were finally favorable, but if history was any guide, they wouldn't last long. The increased pricing caused by tight supply in 1985 caused new entrants and re-entrants into the market. In 1985, 15 insurance raised over $3 billion to capture the better industry pricing, according to Buffett. Buffett knew it would only be a matter of time before this new capital pushed prices down below the cost of doing business, and the cycle would start all over again. There was a bright spot in the darkening cloud Buffett painted, one uniquely suited for Berkshire. Berkshire had built a unique advantage through a combination of its excellent track record, good reputation, and significant capital base. The latest cycle reminded some insurance buyers that premiums only paid for an IOU, and that if the insurer or reinsurer went belly up, payment wasn't guaranteed. Most consumer-type insurance contracts have some industry protections, but others, like reinsurance contracts, do not. Berkshire's unparalleled financial strength meant that buyers of insurance or reinsurance knew their backer would be around if and when it came time to pay. Fireman's Fund Quota Share Contract. A major new source of insurance business presented itself during 1985 when Jack Byrne, CEO of Geico, departed to run Fireman's Fund, another insurer. Berkshire struck an arrangement to participate in 7% of virtually all of the business of Fireman's Fund for 4 years. Directly and through some subsidiaries, including a newly formed subsidiary at Wesco, Berkshire would be remitted premiums and pay claims promptly. It would be as if Berkshire created a brand new insurance company of its own overnight, complete with favorable float characteristics, which it could invest as it saw fit, unlike a direct investment in equity, and a well-seasoned manager in Byrne. The business from Fireman's Fund would be managed by Berkshire's National Indemnity Company and a newly formed Wesco Financial Insurance Company, WES-FIC. National Indemnity would write 5/7 of the business, while Wesco FIC would take the remaining 2/7. Since Fireman's Fund was doing about $3 billion of business, that meant the 7% share for Berkshire represented over $200 million of premium volume. Even though Berkshire had a majority ownership in Wesco and could direct its activities, it deferred to the Peters and Caspers family, descendants of Wesco's founder who still had a minority position, in deciding whether to enter the reinsurance business with Fireman's Fund. This was an unusual degree of deference for a majority owner to show, but it was also a very shrewd, quiet advertisement to demonstrate to others how Berkshire treated its financial partners. This reputation would pay off in the future with other acquisitions. Investments. Practically jumping off the page, see Table 5.2, was a large $469 million gain on sales of securities during 1985. Buffett tempered the enthusiasm for this by likening it to the day of a college graduation where nothing more is learned yet the degree is suddenly bestowed. Like the college degree, Berkshire's large security gains in 1985 were the result of years of behind-the-scenes accumulation. A significant part of the year's realized gains was due to a $338 million pre-tax gain from the sale of General Foods. Buffett was content to let Berkshire own General Foods, which it purchased in 1980, indefinitely, owing to the combination of good business economics and management quality. However, the stock was successfully targeted as a takeover by Philip Morris, and Berkshire found itself with cash instead. In addition to the large capital gain realized on the sale of its General Foods stock, Berkshire recognized a $4.1 million special distribution, which occurred prior to the takeover. It also recorded a $14.9 million special distribution from the Washington Post Company. Both were structured as share repurchases but acted and were taxed by the IRS as dividends owing to the exact same pre- and post-sale ownership percentages. These were like the Geico special distributions buyback arrangements done in prior years. Berkshire's investment portfolio continued to show high degrees of concentration. At year-end 1985, the portfolio had a market value of just under $1.2 billion, with a cost of $275 million. The biggest change in the portfolio over the preceding 12 months was the elimination of $152 million, year-end 1984 value, positioned in Exxon Corporation. Geico, the largest holding by far, reflected Buffett's degree of confidence in the insurer. The Geico investment had a cost basis of just $46 million and a market value at the end of 1985 representing 50% of the total portfolio. That Buffett was willing to maintain 50% of the portfolio in one company and 85% in just four reflected his belief in concentration. It also reflected the relative scarcity of great investment opportunities. The Washington Post provided a good example of how investors' attitudes had changed from pessimistic to optimistic. The Washington Post, valued by the stock market at around $100 million when Berkshire first purchased its $10 million stake in 1973, was now worth 20 times that much. The increase reflected the managerial skill of Catherine K. Graham and her willingness, with Buffett's urging, to repurchase shares when they were depressed. It also reflected a growing sense of optimism for stocks in general. The bond portfolio is also worth a note, especially Washington Public Power Supply Systems, WPPSS. Bonds of the roughly $400 million of tax-exempt bonds held in the insurance subsidiaries, almost half, or $194 million at amortized cost, were WPPSS bonds. The WPPSS bonds alone provided Berkshire with around $30 million of tax-exempt interest annually, amounting to one-third of Berkshire's $95 million investment income that year. Capital Cities, ABC, Incorporated. The news Buffett couldn't wait to tell shareholders in his letter, both literally as it had to be disclosed, but more so because it was exciting news, was Berkshire's investment in Capital Cities, ABC, Incorporated, Cap Cities. Berkshire purchased 3 million shares of Cap Cities at the beginning of 1986. The $517.5 million purchase was made to assist Cap Cities in financing its $3.5 billion purchase of ABC. The deal was a white knight situation that helped Cap Cities avoid the destructive tendencies of the leveraged buyout trend of the 1980s. It also brought Berkshire together with Thomas Murphy and Dan Burke, two managers Buffett highly admired. I've been on the record for many years about the management of Cap Cities. I think it is the best of any publicly owned company in the country. Berkshire provided Murphy and Burke with an extraordinary agreement that spoke to Buffett's confidence in them. Provided that either Murphy or Burke occupied the CEO role, Cap Cities would have an irrevocable proxy to vote Berkshire's 18.7% interest in the company for 10 years. Why do this? Handing Berkshire's vote to Cap Cities would allow the managers to focus on running the business and not lose any sleep looking over their shoulder and wondering what their new owner might do in the future. The move amounted to providing the management of a public company an advantage of a private company, the ability to think and act long-term rather than appease an ever-changing roster of shareholders. Miscellaneous. Reflecting its equity base, Berkshire raised the threshold of businesses it was looking for in its recurring business wanted advertisement to $10 million of pre-tax earnings. The equity base was now over $1.8 billion at year-end 1985. Berkshire and its subsidiaries would continue to seek and close tuck-in acquisitions, smaller acquisitions of businesses folded into existing units that made sense, but Buffett wanted to focus on the big fish. The Illinois National Bank, which had been divested by Berkshire at the very end of 1980, by law and not by choice, was sold in 1985 to AmeriCorp Financial. Having cut the cake and let shareholders choose first, Buffett was pleased that any slice, shareholders could choose all Berkshire, all bank, or a combination of the two, had been reasonably equitable. Overall, the year 1985 was a good one for Berkshire. Its existing businesses, including its primary line of business, insurance, were doing well. It also found profitable new investment opportunities in Cap Cities, in a new major subsidiary in Scott Fetzer, a nesting doll of a business which had subsidiaries and subsidiaries of subsidiaries that would join the Berkshire family in early 1986. The closure of the textile business was bittersweet but necessary. Berkshire was moving firmly and swiftly into the future. 1986. Results for 1986 for the most part did not disappoint. The acquisition of Scott Fetzer in January and later, in June, of Fetchheimer Brothers, pushed consolidated revenues past the $2 billion mark, up from under $1 billion just a year earlier. Insurance, Berkshire's largest line of business, improved, and Geico, its major insurance investee, continued to prosper. Berkshire did face some headwinds in 1986. A rising stock market helped Berkshire's investment portfolio, but also left fewer investment opportunities since companies became more fully priced. A major tax law change in 1986 affected Berkshire's businesses and its investees in different, and not always positive, ways. Buffett took pains to point out that Berkshire's book value increased $492.5 million, or 26.1% in 1986, was of a very high quality. Some companies grew their businesses by issuing new shares, which gave management a larger business to manage, but left shareholders, on a per-share basis, worse off. Berkshire, by contrast, had grown by 10,600%, or 23.3% compounded annually over the 22 years under Buffett's management, all while diluting shareholders' ownership interest by less than 1% per year. As Buffett saw it, he and Charlie Munger had a two-pronged job description. One was attracting and motivating managers who ran the various subsidiaries. One of Buffett's favorite ways to praise managers was naming them in his chairman's letter. The first page of the 1986 letter praised the Blumkin family of Nebraska Furniture Mart, Mike Goldberg, who ran the insurance group, Chuck Huggins at Sears, Stan Lipsey at the Buffalo News, and two newcomers, the Heldmans, who ran Fetchheimer, and Ralph Shea at Scott Fetzer. The other part of the two-pronged job description was capital allocation. Because Berkshire's businesses were so good, they used very little capital and generated gobs more, and because Berkshire retained all of its earnings, Buffett's job was a considerably more important challenge than at most companies. Shareholders used to reading his chairman's letters knew he was not showing off. It was simply basic math. As Buffett put it, in a company adding only, say, 5% to net worth annually, capital allocation decisions, though still important, will change the company economics far more slowly. Berkshire was like a ship, and a very fast-moving one at that, with a very sensitive rudder. One wrong move, a twitch even, could send the ship off in the wrong direction. For that reason, Buffett preferred to patiently wait for the right opportunities. Finding few in 1986, Scott Fetzer closed in 1986, but was really a decision made in the prior year. Berkshire's main capital allocation moves in 1986 were to pay off debt and stockpile funds. Looking at Berkshire's consolidated balance sheet for year-end 1986, we can see just how conservatively financed it was. About half, 55% of the Berkshire's $4.44 billion in assets were funded with equity, including minority equity stakes, the most permanent of funding sources. The liabilities section, because of the Berkshire's insurance business, was somewhat obscured. The $2.02 billion in liabilities were surely real, but their nature was unique. The insurance float that Buffett so loved was made up of the liabilities owed to policyholders for premiums not yet earned by the insurer or claims not yet paid. These liabilities were of a higher quality because they had no due date and were regenerated each time the insurance group wrote additional business. At $414 million at year-end 1986, the deferred income tax line item funded over 9% of Berkshire's assets. Like insurance float, deferred tax liabilities benefited Berkshire because there was no contractual due date. The liabilities arose largely from significant investment portfolio appreciation, in addition to other tax to GAAP timing differences. In the case of taxes due on unrealized appreciation of investments, the tax was only due to the government if or when the security was sold. In this way, Berkshire could put more funds to work than it otherwise could have had it sold the investments and paid the taxes every year. Deferred taxes, as Buffett would later write, an interest-free loan from the government, and would become an important, though not well understood, source of funds in future years. Berkshire, like most other companies, also had interest-free funding sourced from the spontaneously generated working liabilities, such as accounts payable and accruals, but these were a mere normal part of doing business and largely not controllable. The only true debt on Berkshire's 1986 year-end balance sheet was $95 million of long-term borrowings. After paying a premium to retire an obligation from 1980, Berkshire only had about $17 million of term debt at the parent level. Its subsidiaries, including its newest acquisition, Scott Fetzer, which came to Berkshire with debt of its own, had a total of about $78 million of debt at year-end. To put this in perspective, Berkshire could pay off the entire $95 million using just 7 months of 1986 after-tax operating earnings. Scott and Fetzer Company. On January 6, 1986, Berkshire Hathaway acquired Scott and Fetzer Company, a small conglomeration of 17 businesses based in Cleveland, Ohio. The addition of Scott Fetzer's $700 million in revenues nearly doubled Berkshire's revenue base. Scott Fetzer came to Berkshire after a few zigs and zags. The company had been in play for several years, having been pursued by corporate raiders. After a failed attempt to take the company private via an employee stock ownership plan, Buffett wrote its CEO, Ralph Shea, expressing interest in purchasing the company. Buffett and Munger met with Shea for dinner in Chicago, and Berkshire signed an acquisition contract a week later. Scott Fetzer had a rich history. Its namesake founders, George Scott and Carl Fetzer, found the company in 1914 in Cleveland, Ohio as a machine shop. Scott and Fetzer were soon joined by Jim Kirby, inventor of the Kirby vacuum cleaner, and over the ensuing years, acquisitions fueled the company's growth. The largest of Scott Fetzer's subsidiaries in 1986 was World Book Incorporated. World Book represented 40% of Scott Fetzer's business and had pre-tax earnings of $22 million under Berkshire's first year of ownership. With twice the unit sales of its nearest competitor and more than the top 4 competitors combined, World Book dominated the industry. Like Nebraska Furniture Mart, this scale allowed World Book to sell its product for less than competitors and still maintain excellent economics for its owner. The encyclopedias were expensive as a set, but on a per-page basis cost just 5 cents. Additionally, the books were well-edited and consumer-focused. Longer entries started simply and built on themselves using increasingly complex words so kids could understand them. The company ranked over 44,000 words by difficulty. Selling World Book was a calling for over half of its salespeople who were teachers or former teachers, and to a lesser extent librarians. The other major standalone Scott Fetzer subsidiary, almost as big as World Book, with pre-tax earnings of $20.2 million in 1986, was Kirby. Kirby sold high-priced but long-lasting vacuum cleaners. It had been doing so since the company was founded by its namesake founder, Jim Kirby, in 1906. Although Kirby and its sister company, World Book, were very different, they shared one important trait. Both Kirby and World Book were sold via the direct sales model, at the time often referred to as door-to-door. Other Scott Fetzer companies, though not of the same size or scale as World Book or Kirby, nonetheless possessed similar economic characteristics. They were basic, almost boring businesses, such as Campbell Housefield air compressors and Wayne burners and water pumps. They also included Adelet, France, Halex, Merriam, and Northland, which made products and components for industrial use or small parts that would ultimately end up in finished products sold to consumers. The basic but critical nature of many of the products, combined with their low relative prices compared to the price of the end product, meant the businesses were able to generate strong returns on capital. These businesses collectively earned $25.4 million in 1986. Scott Fetzer also came with a small finance organization. Both World Book and Kirby were supported by subsidiaries which allowed customers to buy on credit. These receivables and installment loans were in turn partly financed by term debt. Buffett considered a conservative amount of debt appropriate for such an operation, which was akin to a small bank that paid a rate of interest for interest-bearing accounts and earned a spread on what it charged customers for loans. Buffett was thrilled by the acquisition and called it a prototype, understandable, large, well-managed, a good earner. Judging by the financial results, Scott Fetzer was indeed a good earner. Over the 10 years ending in 1984, the last full year available, Scott Fetzer earned an average pre-tax return on capital of 22.5%. If adjusted for excess cash on the balance sheet, this figure rises to 28.2%. Scott Fetzer past successes had resulted in the company carrying cash and short-term investments of upwards of 50% of shareholders' equity. Upon purchase, Scott Fetzer paid Berkshire a $125 million dividend. This reduced Berkshire's $410 million purchase price, including $90 million of assumed debt, to $285 million. Even after paying a modest multiple for Scott Fetzer's underlying capital, Berkshire would earn a 25% pre-tax return on its investment in 1986. The Fetchheimer Brothers Company. Berkshire's second acquisition of the year was Fetchheimer Brothers Company, which closed on June 3rd. The company came to Berkshire as a direct result of Buffett's annual advertisement in his chairman's letters. As Buffett told the story, early in 1985 he received a letter from Bob Heldman in Cincinnati informing him that the company he chaired passed Buffett's test. Fetchheimer passed the simple test with flying colors. Founded in 1842, it manufactured and distributed uniforms. Though a simple business, Fetchheimer was highly profitable. The underlying business was earning 50% or more on capital per year. Like Scott Fetzer and many other companies of the 1980s, Fetchheimer had gone through the unpleasant experience of being owned by those seeking short-term profits. In 1981, the company was the subject of a leveraged buyout transaction that saw management, including Bob Heldman and his brother George, president of the company, retain an interest in the business. Having ridden the wave for the typical 5 to 7 year holding period, the venture capitalists wanted out. The Heldman's father, Warren, who had originally gotten the family involved in the business in 1941, sought a permanent home for Fetchheimer. They found that home in Berkshire Hathaway. A short history of leveraged buyouts provides an important backdrop to 1986. The 80s were marked by a boom and bust cycle in private equity that included a wave of leveraged buyouts. In a typical takeover, a corporate raider buys enough stock to gain control. In a leveraged buyout, a company's own executives are often doing the buying. The deals are often financed with high-yield but risky bonds called junk bonds. These kinds of buyouts are hostile. In 1986, a third of mergers and acquisitions were of this type. Fetchheimer was not the only company Berkshire owned or invested in that was affected. The deal with Cap Cities helped it avoid a leveraged buyout, and Berkshire received a windfall when General Foods was taken over in a leveraged buyout. In Fetchheimer, Berkshire received an excellent business at a fair price. Fetchheimer's underlying business was earning 50% or more on capital, and Berkshire's purchase multiple gave it a 26% pre-tax return. Like Nebraska Furniture Mart, Fetchheimer was run by a devoted multi-generational family. Sources of reported earnings. The changes in Berkshire sources of earnings was evident in the now familiar table in the 1986 Chairman's Letter, referring to Table 5.2. To say the addition of Scott Fetzer was a milestone for Berkshire would be an understatement. Scott Fetzer, coupled with improvements in the operating earnings of other Berkshire subsidiaries in 1986, pushed consolidated pre-tax operating earnings to almost $196 million, up more than 56% from 1985. 10 years into its ownership of the Buffalo News, and with its competitor, the Courier Express, gone, Berkshire's paper was thriving. Pre-tax earnings reached $35 million, equal to the entire 1977 purchase price. Under the leadership of Stan Lipsey, the paper was controlling its costs while continuing to provide readers with 50% news whole. Probably because of this commitment to above-average content, its Sunday paper penetration ratio now topped 83%, even higher than the 63% the Courier Express achieved during its long period of Sunday dominance. Buffett praised the amazing Blumkin family at Nebraska Furniture Mart, who continued to perform business miracles. Operating out of a single store, though with an expanded warehouse, Nebraska Furniture Mart was generating $132 million of annual revenues. With little organic growth in population locally in Omaha, customers were coming from far and wide to take advantage of its everyday rock-bottom prices. See's Candy operated in a tough environment and nonetheless increased earnings almost 5% to $30 million. Buffett thought profits should stay at about their present level owing to stagnant same-store poundage. Though See's was able to increase prices minimally and did increase overall poundage by 2%, this was done only by adding stores. See's was, and is, an excellent business with high returns on capital, but this excellence came at a cost of little to no unit growth. Insurance. The insurance group's headline, $55.8 million pre-tax underwriting loss, appeared to run counter to Buffett's prediction of better industry conditions in 1986. Looking more closely at the results between the primary group and the reinsurance group revealed a slightly different story. For the first time since 1981, the primary group reported a pre-tax underwriting gain. This was a result of strength in specialized auto and general liability reflecting tighter market conditions. Read, higher premiums were obtainable. Workers' compensation and home state again wrote to losses, but these were not enough to prevent an overall profit of $3.5 million and a combined ratio of 93.9%. The industry increased premiums by over 22% in both 1985 and 1986. As a result, the industry combined ratio had declined markedly from a high of almost 118% in 1984 to an estimated 108.5% in 1986. Though over 100%, indicating underwriting cost industry participants money, it was in the range of 107% to 112%, and that was enough to produce break-even results after considering the earnings from float. Industry tightness and the higher pricing that went along with it factored into the overall doubling of premiums written in Berkshire's primary segment to $595 million. Earned premiums grew even more, about 2.5 times to $463 million. The only significant black mark on the primary insurer's result was $16 million of adverse loss development included in 1986 results. Representing 7.5% of the beginning reserves, the adjustment was outside of the more respectable plus or minus 5% range that the annual report quoted as a target. Buffett called attention to this fact in the chairman's letter. If the psychological rules that apply to Pinocchio apply to me, my nose would now draw crowds. The story of the reinsurance group in 1986 was one of the generally improving results on a fast-growing book of business. Premiums written and earned were up 222% and 415% respectively. This was largely driven by the 7% quota share arrangement with Fireman's Fund. The combined ratio, which was not ideal at 110%, and resulted in a $49.4 million pre-tax underwriting loss, but it was better than the 119% ratio recorded in 1985 and far better than the 194% recorded in 1984. The reinsurance business could stand higher combined ratios, though probably not much higher than the 1986 result. Remember, the long-tail nature of reinsurance means premiums are held longer before being paid as claims, providing more time to earn investment income. A 110% combined ratio implied a 10% loss from underwriting results. Making up anything more than this from investments would be difficult. According to Buffett's estimates, Berkshire was the fastest-growing large insurer between 1984 and 1986. This contrasted starkly to having been the slowest-growing insurer in the few preceding years. The vacillations were not intentional but market-driven. Berkshire was the industry's most steadfast participant, said Buffett, at the right price. Berkshire was willing to write almost any business if it thought the price was right and the risk manageable and appropriately sized to its capital base. Prior to 1985, it had found the market unreasonable and therefore wrote less business. When the industry tightened, Berkshire wrote more business. For an employee at one of Berkshire's insurance subsidiaries, these swings might have caused apprehensions about job security. To properly incentivize writing only profitable business, Berkshire instituted a no-layoff policy at its insurers. Other insurers paid more attention to volume, either explicitly or via misaligned incentives that caused employees to reason they needed to book business at any cost. Berkshire thought it better to incur a slightly higher expense ratio now rather than a much worse loss ratio in the future. This overall approach focused attention solely on long-term profitability. Geico had an outstanding year in 1986, and because Berkshire had a 41% ownership interest in the insurer, it shared in its success. Berkshire's share of Geico's premiums in 1986 was over $500 million, almost equal to Berkshire's primary insurers combined. Geico's rock-bottom operating costs created a moat protecting it against competitors, and Buffett loved moats. He called what Geico had built a valuable and much sought-after business castle, and said Geico's book of business was one of the best in the world of insurance, far better indeed than Berkshire's own book. Geico wrote 16% more volume in 1986 than the year before. Better yet, it did so at a 96.9% combined ratio. All the while it was repurchasing its own shares, ending 1986 with 5.5% fewer shares than the beginning of the year. The 6,850,000 shares Berkshire carried on its books at a cost of $45.7 million had a market value at year-end 1986 of almost $675 million. But excellent economics driven by low-cost operations was not Geico's only advantage. Geico had another asset worthy of Buffett's praise in Geico Vice Chairman Lou Simpson, the individual responsible for its investments. Simpson had an investment track record that rivaled Buffett's. Buffett even joked that it was only because of his controlling interest in Berkshire that he was comfortable sharing Simpson's record in his chairman's letter. Investments. At year-end 1986, Berkshire boasted a $1.87 billion common stock portfolio and a bond portfolio of $1.27 billion, largely held within the insurance group. Consistent with its owner mindset, Berkshire continued to maintain a highly concentrated common stock portfolio. Buffett told shareholders that he viewed Berkshire's three largest investments as permanent holdings and that he would probably not sell them even if they were to become overvalued. He thought a "till death do us part" policy would set the right tone and allow the managers of those companies to operate without the fear of a large change in ownership. Buffett was communicating his long-term ownership philosophy outside of Berkshire's wholly owned subsidiaries to those of its major investees, and it was done in self-interest. The Washington Public Power Supply System, WPPSS, Projects 1, 2, and 3 bonds were valued at $310 million, or 24% of the bond portfolio. From these, Berkshire received $31.7 million in annual tax-exempt interest. In 1986, Berkshire purchased an additional $700 million of tax-exempt bonds, with maturities ranging from 8 to 12 years. But these purchases were made not so much for their superior investment potential as the most palatable of options available. Buffett liked the prospects of neither stocks nor bonds in 1986, but Berkshire had to hold marketable securities of some kind in its insurance companies and invest them. He even called the bonds mediocre investments and least objectionable. Of the $118 million of interest and dividend income earned in 1986, nearly $72 million was from issues exempt from federal tax. NHP Incorporated. Buffett chose to highlight NHP Incorporated, one of the smaller equity investments that did not make the cut for the table in the chairman's letter. At year-end, Berkshire had a $23.7 million stake in NHP, representing 45% of the company. Highlighting this small investment showed his penchant for storytelling, as well as the relative dearth of great investment ideas at the time. NHP was an unusual corporation formed to develop and manage affordable housing for low and moderate income tenants. It was the product of a political creation, and as such, law required that one of its subsidiaries have 3 directors appointed by the President of the United States and confirmed by the Senate. At the time of Berkshire's investment, NHP managed around 500 properties in 40 states, the District of Columbia and Puerto Rico, or 80,000 total housing units. NHP was owned by Berkshire, Weyerhaeuser, 22% stake, and a group led by NHP CEO Ron Heller, in addition to about 60 major corporations with interest no greater than 2%. Taxation. On October 22, 1986, President Reagan signed into law the Tax Reform Act of 1986. This law significantly altered the U.S. tax code. There were positives and negatives, but the net effect for Berkshire was negative. For owners of Berkshire stock wishing to sell, and assuming business value tracked Berkshire's intrinsic value with corresponding increases in share price, the new 28% capital gain rate would leave fewer net proceeds than the old 20% rate. Corporate capital gains tax increased from 28% to 34%, effective in 1987. Importantly, GAAP reporting still used the old 28% rate at present, meaning $73 million would disappear from Berkshire's net worth when the financial accounting caught up with the new tax changes. Dividend and interest income received by insurance companies would be taxed at a higher effective rate, a significant negative. Previously, only 15% of dividends received from domestic corporations would be taxed. That proportion now increased to 20%. Additionally, for property casualty insurance companies, the remaining 80% will be taxed at 15%. Finally, interest on bonds purchased by property casualty companies after August 7, 1986, would be only 85% tax exempt. There were also a few positives. The tax rate on corporate ordinary income was going down from 46% to 34%, a net positive for Berkshire and most of its investees. A fresh start provision offset some of the negatives affecting insurance. This provision effectively gave Berkshire a double deduction as a one-time benefit for offsetting changes in lost reserve deductions for tax purposes. The tax law affected property casualty insurers acutely, and Buffett estimated it would reduce the earning power of Berkshire's insurance group by at least 10%. Because many insurers had different tax situations due to prior loss carry-forwards or because they were part of other companies, each would respond to the changes differently. The law also affected Berkshire's non-insurance companies in other ways. Buffett posed the question, what really happens when tax rates change? That is, do corporations pass along the increases or decreases to consumers via prices, Or are they absorbed by the corporation with corresponding increases or decreases in profitability? Buffett said the answer depended on the type of business. He laid out three. 1. A utility-type organization would largely be required by regulators to pass along any changes. 2. Price-competitive businesses. Though not publicly regulated, the free market caused prices to adjust in response to tax changes. 3. Unregulated businesses with strong franchises or moats protecting them. In these cases, such as with Seas, the Buffalo News, and many of Berkshire's other investees, owned in whole or in part, pricing power shielded the businesses from market-driven price adjustments. The 1986 Tax Act also repealed the General Utilities Doctrine. The doctrine formally protected owners from double taxation, once at the corporate level and again at the personal level during corporate liquidations. It did not affect Berkshire directly since Berkshire was long past the point of considering liquidating, but it would impact other companies such as oil and gas, some media companies, and real estate businesses where the operating economics were meaningfully altered because of the change. This meant prospective investment must be evaluated more carefully. Miscellaneous. Jokingly starting this next section with a tiny-sized font, Buffett informed shareholders that Berkshire bought a corporate jet in 1986. Falling on his sword and admitting he changed his mind at what he had previously bemoaned as an unnecessary luxury, he said he experienced a counter-revelation. The jet made travel a lot easier, but costlier. Buffett did note he bought the jet used as depreciation affects planes and cars proportionally. Later dubbed the indefensible, Buffett was perhaps eased into such a purchase by the fact that Scott Fetzer owned a plane. Owner earnings. Buffett excused shareholders from reading his accounting update if they so chose, removing it to an appendix in the chairman's letter. Entitled Purchase Price Accounting Adjustments and the Cash Flow Fallacy, it used Scott Fetzer's before and after financial statements, prior to and after Berkshire's purchase, to illustrate his concept of owner earnings. Under two columns labeled O, old, and in, new, he asked the hypothetical question, which company was worth more? O, showing higher earnings, or in, showing lower earnings? The answer, of course, was that they were the same Scott Fetzer, only manipulated by accounting changes required due to Berkshire having purchased it. The figures for Scott Fetzer are unimportant, but understanding the changes that occur when one company buys another illustrates how economics diverges from accounting. When an acquisition like this occurs, assets and liabilities are appraised at current market values. If inventory was carried on the books at a low price, it is marked up to what it would cost at the time of the acquisition. Similar revisions occur with real estate. Liabilities, too, if they do not reflect current values, are revised, though they are often very accurate. If there is anything left over between the purchase price and the net asset value, it is placed on the balance sheet as goodwill. The net effect of these accounting revisions is often higher valued assets. This affects future accounting in three ways. 1. Higher cost inventory means reported profits are lower. 2. Higher valued real estate, except land which is not depreciated, causes higher depreciation expense. 3. Goodwill amortization, at the time it was amortized for both tax and GAAP purposes, is expensed and lowers profit. The net effect is a new company on paper with greater assets and lower earnings. To an owner, however, the cash flows and intrinsic values were identical. The economics are the same, only the accounting changed. Buffett's owner earnings formula was simple and intuitive. Owner earnings equal reported earnings plus depreciation, depletion, amortization, and any other non-cash charges, minus any capitalized expenditures and related working capital needs required to maintain unit volume. As could be seen in the Scott Fetzer example, earnings charges for amortization created simply by adding and then expensing a new goodwill asset were not real business expenses, but depreciation and the deduction for capital expenditures were very real. Buffett bemoaned the use of the newly trendy cash flow or EBITDA, earnings before interest, taxes, depreciation, and amortization figures being used by Wall Street since they improperly and intentionally omitted capital spending in an attempt to justify certain transactions. Buffett later lamented this accounting mechanism. In 1989, he said it would induce lenders to finance even sillier transactions and called it a sawed-off yardstick, as it was delusional and ignored depreciation. Thus, 1986 ended with a Berkshire Hathaway sticking, quite profitably it might be added, with sound business principles, logic, and patience. 1987. With the benefit of hindsight, we can view the 1987 results through a different lens. Included at the end of the 1988 annual report were separate, unaudited financial statements that distinguished between Berkshire's main operating activities and included a comparison to 1987. This breakdown better informed shareholders of the economic characteristics of each business line and more fully told the story of the Berkshire's $464 million, or 19.5% increase in book value during the year. The first of these categories was the insurance group, Berkshire's primary economic engine, which held the majority of its assets, including most of its marketable securities portfolio, liabilities, and equity. Next was the manufacturing, publishing, and retail businesses, which aggregated such operating subsidiaries as the Buffalo News, Nebraska Furniture Mart, See's Candy, Fetchheimer, Precision Steel, and the Mini Scott Fetzer subsidiary businesses. The finance-type businesses category included Wesco's Mutual Savings and Loan, as well as the Scott Fetzer Financial Group. Lastly, the non-operating activities segment held everything that did not fit into the other categories, including general corporate overhead for Berkshire's headquarters and parent company debt. Importantly, the non-activity segment also included goodwill and property account adjustments and the related amortization, which were separated from the business acquisitions that created them. GAAP accounting conventions included such amortization with each business, which obscured the underlying business results. Insurance Group. Looking at the insurance group, it is quickly apparent that its 12 individual subsidiaries considered the bulk of Berkshire Hathaway's operating activities. Even after the Scott Fetzer acquisition in 1986, which added a host of operating businesses, and very good ones at that, Berkshire Hathaway was still primarily an insurance company. The insurance group accounted for 77% of Berkshire's year-end 1987 consolidated assets and a full 84% of its equity. The 1987 insurance underwriting results looked very similar to the prior year, with a pre-tax underwriting loss of $55.4 million compared to $55.8 million in 1986. But important differences existed beneath the surface. Written premiums, which are assigned to the year in which they are written but earned over time, fell by 25%. Earned premiums, because of the aforementioned lag relating to when premiums are actually earned, were essentially flat. Berkshire's combined ratio increased slightly from 103% to 105%. This was very similar to the industry overall, but Berkshire's business model meant it generated more float. In fact, Berkshire's average float in 1987 increased from $800 million to $1.3 billion. Importantly, it cost just 4.4% compared to government bonds that yielded 9%. Higher float directly contributed to the $153 million pre-tax net investment income in 1987, a $45 million increase. There were also important differences within each insurance segment. The primary group, which wrote policies directly to those incurring the insured risks, wrote to a combined ratio of 102.3% compared to 93.9% the year before. The results for 1987 were slightly worse than it seemed. However, when we consider that the $2.7 million pre-tax underwriting loss was after $9.4 million of favorable loss development. Although a positive factor in itself, the inclusion of a favorable loss development meant that business written in 1987 was technically not as profitable as the headline 102.3% might suggest, though its true profitability would take time to pan out. The 1987 results for Berkshire's Reinsurance Group, which through that time excluded structured settlements and portfolio reinsurance, were markedly improved. Coming down from a high of 194% in 1985, the combined ratio for the segment registered at 112% in 1987. This nearly halved the pre-tax underwriting loss compared to the year before, and included just 1.2 percentage points of unfavorable loss development. The last category of the insurance group, which would be combined with the reinsurance segment beginning in 1990, was structured settlements and portfolio reinsurance. These activities, while strictly insurance, were more akin to incurring debt with a roughly known coupon rate. These activities contributed $25 million to the pre-tax underwriting loss from insurance in 1987. While we cannot know for sure, we must assume the area was a profitable one for Berkshire because it remained in the business. Given the improving underwriting and increased float and related investment income, The insurance group could have been considered on the upswing. Quick to temper expectations, Buffett told shareholders, "The party is over." Looking forward, Buffett saw the mediocre 8.7% increase in industry written premiums as inadequate to cover his estimate of the minimum of 10% year-over-year volume increases required to cover the ever-increasing costs of social inflation. Breaking 1987 down into quarterly figures, Best's, an industry publication, showed year-over-year volume increases for the industry falling to below 6% in the second half of 1987. Industry capacity, lured by improving profitability, was already sowing the seeds of its own demise. Berkshire had seen this story play out before and had been warning shareholders of its arrival for several years. Opportunity and ease of entry led to increased premium volume, but not long-term financial gain. Buffett was a long-term pessimist for the industry overall, but a long-term optimist for Berkshire's insurance operations. In doing so, he reminded shareholders of Benjamin Disraeli's observations. What we learn from history is that we do not learn from history. Berkshire, though, was different and could rise above the pack in two ways. First, through capital strength. Though buyers of coverage in short-tail lines such as auto or homeowners would not pay much attention to Berkshire's balance sheet, those buying long-term or large insurance protection would understandably care more deeply about its counterparty's ability to pay when times got tough. This financial flexibility also gave Berkshire the ability to invest in assets that carried expectations of higher returns over the long run. It could hold higher concentrations of stocks compared to bonds, or even own whole businesses within the insurance companies. The tight capital ratios maintained by other insurers sometimes prevented them from holding higher levels of stocks or illiquid investments. The second factor providing Berkshire an edge over its competition was its total indifference to volume. Because of its financial flexibility and the industry's characteristic of ease of entry, Berkshire could stand by until industry conditions were favorable. Buffett had seen the ill effects of other companies focused on volume over profitability and instituted a culture focused on profitability above all else. As discussed in the segment on 1986, he even maintained a policy of no layoffs to ensure managers and employees would not be tempted to make decisions based on short-term gains. Manufacturing, publishing, and retailing. Berkshire's small but growing non-insurance operating business segment represented 8% of its total consolidated assets and 6% of its equity. Berkshire would not formalize the category until the 1988 annual report. However, the chairman's letter for 1987 included clues to its formalization as a separate business unit, at least in Buffett and Munger's minds. Buffett dubbed the largest of these non-insurance businesses the Sainted Seven. They included the Buffalo News, Fetchheimer, Kirby, Nebraska Furniture Mart, Scott Fetzer Manufacturing Group, See's Candies, and World Book. They were excellent businesses with excellent leaders. Human nature leads business leaders to tell others that his or her managers are wonderful, but Berkshire's operating managers truly deserve their high praise. The group of Sainted Seven businesses earned $180 million before interest and taxes in 1987 and $178 million after $2 million of interest expense. Though the tiny amount of interest expense was information enough to judge the businesses as conservatively financed, there is more to the story. Earnings had to be compared to the capital that was required to produce the earnings to fully assess the economic performance. As it was, this group required just $175 million, which put their after-tax return on equity capital at a mouth-watering 57%. But that was not the whole story. The $175 million figure was the historical cost basis of those companies' capital, an important distinction. Because Berkshire paid a premium to acquire them, the accounting required adjustments to certain accounts and the addition of goodwill. These were not insignificant. Berkshire paid approximately $222 million more than that $175 million. Buffett thought that the operating managers should not be judged on the higher figure, since his agreeing to pay a higher price than the underlying capital didn't magically give those managers additional capital to employ. Having paid that premium, Buffett could rightly be judged by the lower 25% after-tax return. The first-class problem that came with owning such wonderful businesses was that of reinvestment. The businesses earned high returns on capital but could not profitably reinvest much more capital at such high rates, though they tried. As a result, excess cash was usually sent to Omaha to find the best use for it. Buffett and Munger could reinvest it in other subsidiaries with growth potential. The insurance group was the recipient of numerous capital injections over the years. purchase other operating businesses, or buy marketable securities. The important thing was that the operating managers had a relief valve for excess capital that mitigated making subpar investment decisions, and they were incented to grow only if that growth was profitable. The 1987 chairman's letter gave a quick update on each of the major operating units within the manufacturing, publishing, and retailing segment. Buffett noted that his brevity was not a lack of recognition for good work, but that much had already been said in the past and little had changed. As he wrote, "Experience indicates that the best business returns are usually achieved by companies that are doing something quite similar today to what they were doing 5 or 10 years ago." Buffett therefore kept his updates brief. Nebraska Furniture Mart was humming along nicely, with sales at its one store up 8% to $143 million. The Buffalo News continued to dominate its market and maintain high penetration rates, driven by local reporting. Its commitment to a 50% news haul would remain unchanged, even if margins declined and profits fell, which they were expected to do given skyrocketing newsprint costs. Fetchheimer, with 3 generations consistently driving the simple uniform business, increased profits to a record $13.3 million pre-tax. See's sold a record 25 million pounds of candy and had flat same-store sales. Flat same-store sales was praiseworthy compared to 6 years of declines amid ever-shrinking consumption by consumers. Scott Fetzer increased pre-tax earnings by 10%, all the while decreasing average capital employed. Clearly, these businesses and their managers deserved the loud, informed applause Buffett gave. Finance-type businesses. The 2 businesses making up this segment in 1987 were Wesco's Mutual Savings and Loan and Scott Fetzer Financial Group, part of Scott Fetzer. The latter was a separate operating subsidiary under the Scott Fetzer umbrella, set up to finance consumer purchases of such products as the World Book and Kirby. While Mutual Savings was in fact a bank, Scott Fetzer Financial Group operated as one. Both were highly leveraged as measured by an asset-to-equity ratio. However, unlike Mutual Savings, which primarily used savings accounts and other deposits to fund itself, Scott Fetzer Financial financed its assets with term debt. Viewing this segment as a bank, we can observe that at year-end 1987, it had equity amounting to 15.5% of its total assets. This was akin to a bank's capital ratio, and at that level would be considered well capitalized. Another standard metric by which banks are measured is return on average assets, which measures operating performance. An estimate of the 1986 return on assets for Berkshire's finance-type businesses of 2.6% would have ranked it among the very best banks. Non-operating activities. The non-operating activities segment was the proverbial kitchen sink. It held accounts including acquisition, created property adjustment, and goodwill. These 2 items alone totaled about $210 million and accounted for almost 60% of the assets reported in the segment. The income statement of the segment suffered from the related amortization charges. While the segment did hold some real assets, such as cash and marketable securities, it was clear the breakout was meant more as a cleanup to reconcile the GAAP financials rather than to provide substantive analytical value. Investments. Primarily held within the insurance group, Berkshire's marketable securities were viewed as a separate entity from the underwriting activities. The latter were managed by the various operating managers, while the former was entirely under the direction of the chairman and vice chairman. Buffett's evolving attitude toward owning great businesses for the long term started to show when he elevated several equity investments to the level of a permanent operating company status. To be sure, they were subject to sale if the insurance group needed the funds to pay claims. However, he thought of 3 of Berkshire's partial ownership positions as essentially no different than wholly owned ones. Buffett summed it up succinctly. Eventually, our economic fate will be determined by the economic fate of the business we own, whether our partnership is partial or total. These 3 permanent holdings were the relatively recently acquired 3 million shares of Capital Cities ABC Incorporated, the 6,850,000 shares of Geico, and the 1,727,765 shares of the Washington Post Company. Together, they had a market value of over $2.1 billion at year-end 1987 and represented most of the $2.3 billion total equity portfolio. The attitude of permanence for the select few marketable securities investments could not overcome 2 distinct advantages as a wholly owned businesses afforded Berkshire. One was capital allocation. Though it seldom did in practice, Berkshire could direct the operating subsidiaries as it saw fit, including reallocating excess capital elsewhere. The second advantage of control was taxes. Berkshire could reallocate capital within and across subsidiaries without any tax consequences. With investments below an 80% ownership position, such as in the case of its marketable securities portfolio, Berkshire was subject to double taxation of dividends and a higher capital gains rate. If the three permanent holdings of common stock Berkshire held at the end of 1987 were de facto operating subsidiaries, then that left the $222 million other equities as everything else. To place over 44% in one company, Cap Cities ABC, and over 90% in its top three holdings reflected a significant degree of concentration by Wall Street standards. But it also reflected the paucity of investment opportunities available at that time. Some of that $222 million remainder was invested in short-term arbitrage positions, taking advantage of short-term pricing differentials, usually upon an announced merger or acquisition. But otherwise, Buffett found stocks unattractive. The October 19, 1987 Black Monday crash that led stocks to tumble over 22% was dramatic, to be sure. It was one of the worst stock market crashes in the history of Wall Street. But the quick rebound and already high levels of the market still left the index up 2.3% for the year, and Berkshire unable to find a bargain. The fixed maturity portfolio, read bonds, was no different. Considering the possibility of inflation and the United States' enormous trade deficit, Buffett wrote that he and Berkshire would continue to have an aversion to long-term bonds, and even posed the possibility that medium-term bonds were being similarly disadvantaged. Instead, like the equity portfolio, Berkshire concentrated its $2 billion bond portfolio. A full $240 million of that was the Washington Public Power Supply Systems, WPPSS, tax-exempt bonds. Almost 35% of the fixed maturity portfolio was comprised of the carrying value of a new investment in Solomon Incorporated. The 9% convertible preferred stock investment, worth $700 million, received much fanfare from the business press, though the investment into one of Wall Street's leading investment banks would later haunt him, and at the time, Buffett viewed it as a medium-term fixed-income investment with an interesting conversion possibility. The issue was converted after 3 years into Solomon common stock at $38 per share. Another large part of the fixed maturity portfolio was $104 million of Texaco bonds. The short maturity bonds were purchased after Texaco had filed for bankruptcy. Owing to the insurance group's strong capital position, Berkshire was able to make the investment into the significantly marked down bonds where another insurer could not. Wesco, K&W, and Harry Bottle. Included as a regular part of the Berkshire report was Charlie Munger's Wesco chairman's letter. In it, he continued to urge Wesco and Berkshire shareholders not to think of Wesco as a miniature Berkshire Hathaway. Its mutual savings subsidiary was mediocre, Munger wrote, because of tough industry conditions. These conditions stemmed from less well-behaved participants using the government's credit to attract deposits and then turn around and lend them in a risky manner. A $1.9 million after-tax charge Mutual Savings took in 1987 to write off prepayments of its deposit insurance premium, presumably now economically worthless, reflected Munger's pessimism. Mutual Savings did have some bright spots in its well-located headquarters building and its 31 building lots under development. All in all, Munger thought Mutual Savings could average 10% per year on the after-tax proceeds, which could be realized from its liquidation. Moving to Wesco's better operating subsidiaries, Munger described the 100-year-old flood that hit Precision Steel that year. Actual flood damage cost $672,000 loss after a severe rainstorm in August 1987. Munger was a frequent critic of aggressive accounting, including of managers who repeatedly excluded such one-time items from earnings discussions, but he had no hesitation excluding this one-off mishap from a natural disaster. Wesco Financial, Wesco's newly formed insurance subsidiary, received another $45 million from the parent entity to take advantage of the Fireman's Fund increasing volume. In 1987, premiums earned by Wes FIC amounted to over $73 million and afforded Wesco with the use of the related float. In more good news, a $9 million venture capital type investment in a resuscitated Bowery Savings Bank was sold for an after-tax gain of $5 million after a friendly takeover. The risk-reward bet had paid off handsomely. Some investors in the project are now familiar names: the Tisch family, the family behind Lowe's Corporation, and Richard Rosenthal, a former Solomon partner who died in a tragic plane crash that year. A final anecdote complemented Buffett's 1987 chairman's letter. He wrote of the déjà vu experience of working with Harry Bottle. Bottle earned his reputation with Buffett when he quickly turned around an investment Buffett Partnership Limited had in Beatrice, Nebraska-based Dempster Mill in 1962. 24 years later, Munger tapped Bottle to turn around Wesco's K&W Products subsidiary. The small automotive compound manufacturer struggled under its previous CEO, who lost focus. Munger made him CEO and sat back to await the inevitable, wrote Buffett. Very soon, Bottle had cut receivables and inventories by 20%, while growing profits more than 300%. Bottle clearly deserved his reputation for turnarounds, which left Buffett to muse that he'd be the first one on the list to call if another situation arose. For now, though, Berkshire and its subsidiaries were in good shape. 1988. The resiliency of the Berkshire Hathaway model under the leadership of Warren Buffett and Charlie Munger shone through in 1988. While Berkshire found a couple of new investment opportunities that year, the investment climate was largely against them. Nonetheless, Berkshire's momentum carried it forward to a 20% gain in book value. That was due to past capital allocation decisions and the dedication and ongoing commitment of Berkshire's managers and employees. The compounded annual rate of return for the 24 years under Buffett's leadership was 23%, a doubling almost every 3 years. Repeating the past record would be very difficult, if not impossible. The major problem Berkshire faced was its past success. Such high rates of historical return had grown shareholders' equity from a mere $22 million in 1964 to over $3.4 billion in 1988. Even just 15% growth would necessitate earning $10.3 billion over the ensuing decade. Berkshire had great businesses such as the Sainted Seven, non-insurance operating subsidiaries, the Buffalo News, Fetchheimer, Kirby, Nebraska Furniture Mart, Scott Fetzer Manufacturing Group, Seas, and World Book, but these could only do so much. Berkshire faced other strong headwinds. The stock market had become more fully priced and was thus less attractive. In a similar vein, plentiful credit drove up prices of entire businesses, and corporate tax rates were less favorable than in the past due to a series of tax overhauls starting in 1986. Finally, Berkshire's permanent investments, its significant ownership interests in Capital Cities ABC, Geico, and the Washington Post, faced more difficult industry operating conditions. Accounting changes. Major changes to Generally Accepted Accounting Principles, GAAP, mandated the full consolidation of subsidiaries on Berkshire's balance sheet and income statements in 1988. Mutual Savings Scott Fetzer Financial, the entity that provided financing to World Book and Kirby customers, had been included on an equity basis. The results were condensed into net profit and equity, and Berkshire's ownership interest in each was included on the income statement and balance sheets, respectively. Now everything would be broken out with appropriate minority interests deducted in separate lines. This was not unlike the treatment for many of Berkshire's other operating subsidiaries, such as the 84% owned Fetchheimer or the 90% owned Nebraska Furniture Mart. The change would affect the comparative periods in Berkshire's 1988 financial statements, but not the economic reality. Possibly due to the above-mentioned accounting changes, Berkshire presented a supplement in the annual report beginning in 1988. It broke down its business lines into groupings more closely aligned with economic reality. Insurance Group, Manufacturing, Publishing, and Retail Businesses, Finance-type businesses, Mutual Savings and Scott Fetzer Financial, non-operating activities. Buffett had long said that Berkshire's consolidated parent-level financial statements were of little analytical value to shareholders. For this reason, he presented significant detail in the chairman's letters for each segment to aid shareholders' analysis of Berkshire. Buffett said the number and diversity of Berkshire's subsidiaries made this segment data essential to answer 3 questions. 1. How much is the company worth? 2. Is the company likely to meet its future obligations? 3. How well are managers doing with the hand they are dealt? These were the questions Buffett asked, and he believed shareholders would also want answers. The supplemental data aided analysis without overloading shareholders with details. Buffett and Munger had always had easy access to this data. Putting themselves in shareholders' shoes, something they did often, they realized shareholders would also want this information. Sources of reported earnings. For the summary table provided in the chairman's letter, refer to Table 5.2. It was quickly apparent that 1988 was a highly satisfactory year for Berkshire. The insurance group, which we will analyze later, posted improved underwriting and net investment income also increased notably. Most non-insurance businesses performed very well in 1988. Manufacturing, publishing, and retailing. The overall results for the manufacturing, publishing, and retailing segment were a $202.3 million pre-tax profit, which translated into $121.7 million of after-tax earnings for Berkshire. Pre-tax return on tangible capital was an astounding 89.2%. The group generated a 107.2% and 66.8% pre- and after-tax return on average tangible equity, respectively, while employing just 18% leverage from borrowed funds. Led by the still hard-charging 95-year-old Rose Blumkin, Nebraska Furniture Mart turned in even higher profits of $18 million pre-tax, up 10%. The store had just opened a detached 20,000-square-foot clearance center to continue to provide rock-bottom prices to customers. Dillard's, a large nationwide department store, entered the Omaha market that year without its customary furniture department. This was a testament to the power Nebraska Furniture Mart had in Omaha. Buffett relayed comments that went further. Paying Nebraska Furniture Mart and the Blumkins a high honor, Chairman William Dillard said, "We don't want to compete with them. We think they are about the best there is." High praise indeed. The Buffalo News, led by Stan Lipsey, delivered a record pre-tax profit of $42.2 million, up 8%, all while continuing to provide readers with an above-average 50% news haul. The expected decline in operating margins hadn't occurred. Chuck Huggins led Seas to sell a record 25.1 million pounds, increasing pre-tax profits 2% to $33 million, against a backdrop of tough industry conditions. More impressive, a full 90% of the candy company's profits were earned in the month of December. At Fetchheimer, the uniform manufacturer, Buffett displayed his trust in the Heldman family by allowing them to make a fairly good-sized acquisition that year without either Buffett or Munger's permission. Their trust was well earned, and the Heldmans delivered, with pre-tax profits improving 6% to $14 million in 1988. Buffett heaped much praise on Ralph Shea at Scott Fetzer. In addition to operating Scott Fetzer's 19 subsidiaries, Shea was on the boards of many nonprofit institutions in the Ohio region. Though the Scott Fetzer Manufacturing Group, everything other than World Book, Kirby, and the Scott Fetzer finance businesses, saw pre-tax earnings decline 7% to $29 million, Scott Fetzer's two largest subsidiaries, broken out separately, did well. World Book improved pre-tax earnings by 8% to $28 million, and Kirby improved them by 20% to $27 million. Insurance. AM Best estimated written premiums for the insurance industry grew just 3.9% in 1988. This was below the 10% threshold Buffett estimated that needed to maintain profitability amid social and general inflation. As a result, the industry's combined ratio ticked up from 104.6% to 105.4%, and Buffett estimated it would get worse considering insurance industry executives' tendency to under-reserve. Public anger over insurance rates made an already challenging industry even more challenging. The commodity-type business economics of insurance made it difficult to raise prices and resulted in poor results. A new California law compounded these challenges. Proposition 103 required prior approval before insurance companies could issue rates. Soon after passing, it was suspended pending court review. Proposition 103 was the result of outraged consumers trying to keep down insurance costs. Though Berkshire typically walked away from subpar rates anyways, its major investee, Geico, wrote about 10% of its business in California. More worrisome for Geico and perhaps for Berkshire overall would be if other states saw a similar ballot or legislative initiatives. In another negative for Berkshire's insurance operations, its 4-year 7% quota share with Fireman's Fund expired in late 1989. As a result, Berkshire would have to return an estimated $85 million of unearned premiums, including its float. The returned premiums would flow through the premiums written account as a negative figure, but wasn't expected to significantly impact profits. Overall, pre-tax underwriting losses shrunk 80% from $55 million in 1987 to just $11 million in 1988. The primary group, where premiums written and earned fell 47% and 34% respectively, nonetheless turned in a combined ratio of 103.1%. The 1988 result benefited from $29.1 million of favorable loss development, the second year in a row that occurred. Within the reinsurance group, premiums were similarly off by 38%, both on a written and earned basis. The segment's combined ratio of 110.4% was another improvement over prior years and included no impact from loss development. Structured settlements, separated from reinsurance for the time being, contributed $14.1 million of pre-tax loss to the overall $11.1 million insurance group pre-tax loss. Commenting on the significant decline in premium volume, Buffett wrote, "So be it. Berkshire would continue to write business solely on profitability, results fall as they may. It would wait patiently, ready for the deluge of insurance businesses that would someday come its way. Berkshire's 1988 insurance experience of significantly reduced written and earned premiums, combined with improved underwriting results and significantly higher investment income, made it, in the words of Nassim Taleb, anti-fragile. Berkshire positioned itself so that no matter what happened in the industry, it benefited. When pricing made sense and volume was there, its capital base and AAA Standard & Poor's credit rating, the highest level possible, enabled it to write huge amounts of premiums. When rates were inadequate, it let business fall off and continued to benefit from previously sound underwriting practices and float. Float grew from $1.46 billion in 1987 to $1.54 billion in 1988. This highlights the fact that growth in float is only partially dependent upon premium volume. Float can grow while premiums fall if premiums and incurred losses are held longer. Finance-type businesses. The finance-type businesses, Mutual Savings and Scott Fetcher Financial Group, did well in 1988, largely due to the absence of the one-time Federal Savings and Loan Insurance Corporation write-offs. In addition to strong volume at World Book and Kirby, pre-tax profits rose 47% to $13.5 million. This translated into an after-tax return on equity of 13.4%. Investments. Berkshire considered 5 investment categories Berkshire's insurance group could choose from. 1. Long-term common stock commitments. 2. Medium-term fixed income securities. 3. Long-term fixed income. 4. Short-term cash equivalents. And 5. Short-term arbitrage. In 1988, Berkshire made 2 major commitments to the first option. One was the Coca-Cola Company and the other was Federal Home Loan Mortgage Corporation, better known as Freddie Mac. Coca-Cola cost $592 million for 14.2 million shares, and Freddie Mac cost $72 million for 2.4 million shares of preferred stock. The latter was considered the financial equivalent to a common stock since it had a claim on residual earnings and so was included in the table. It was also the maximum allowed by law, representing 4% of the company. The investment rationale was described by Munger in his letter to Wesco shareholders. The Freddie Mac shares were held at Wesco and the Mutual Savings subsidiary and is discussed below. The Coca-Cola investment was another permanent holding, though Buffett did not say so. He only hinted at it. Berkshire was feverishly buying all the shares of Coke it could get. Buying continued into 1989. Given the background of an expensive stock market, finding Coca-Cola at an attractive valuation suggested the market did not yet fully appreciate its excellent business attributes. Those attributes included a base business selling syrup to bottlers who turned around and sold it to consumers. Population growth coupled with increasing per capita incomes meant Coke had a long runway. Coke's unmatched distribution system put its products in front of consumers worldwide, and those consumers increasingly guzzled the company's products. Coca-Cola was like See's in its high margins and low capital requirements. Perhaps most importantly, Coca-Cola had an attribute See's lacked: reinvestment opportunities. Growth at high incremental rates of return meant Berkshire's seemingly low going-in return, or said another way, the high price, would quickly become more favorable. In hindsight, Berkshire's purchase of Coca-Cola looked like a bargain. Coca-Cola was one of only a handful of businesses about which we have strong long-term convictions, Buffett said, adding that its management had both integrity and ability and loved the business. This praise was akin to that of Berkshire's permanent holdings of Capital Cities ABC, Geico, and the Washington Post. Berkshire also chose investment option number 5, arbitrage. Berkshire's $282 million RJR Nabisco investment was an arbitrage commitment. The commitment, which had a market value of $305 million at year-end 1988, and which was eliminated shortly thereafter at the beginning of 1989 at a better-than-expected profit of $64 million, came about after an announced tender offer from the takeover specialist Kohlberg Kravis Roberts & Company. The takeover company had a long history of completing its deals, and Buffett admired its managers. Buffett would have liked to have purchased more RJR Nabisco stock, but Solomon was involved in the transaction and Buffett and Munger were on its board, thus their directorships cost Berkshire significant money. Solomon would also soon cost Buffett much time, headache, and even risk to his well-earned reputation. Wesco. Buffett's 1988 chairman's letter urged shareholders to read Charlie Munger's Wesco letter, which he said contained the best description of the events that produced the present savings and loan crisis. The unfolding crisis centered on the savings and loan of thrift industry. Thrifts were simple banks designed to take in customers' deposits and reloan them out as safe consumer loans, such as home mortgages and car loans. They were supposed to provide the basic function of moving excess money from savers to qualified borrowers. As a result, they were given special government-mandated privileges to conduct business. Abuses of these privileges led to the downfall of the system. A history buff, Munger excitedly described the story of the Federal Savings and Loan Insurance Company. The FSLIC operated much like the Federal Deposit Insurance Company, FDIC. Wesco's mutual savings and other such banks paid premiums to the FSLIC to insure depositors against losing their deposits if banking institutions failed. Thrifts were supposed to run on boring business models, such as keeping a required 60% of assets in housing-related loans or securities. To help the thrifts carry on their business and attract deposits to fund their loans, legislation gave them a 0.25% advantage over traditional banks. In other words, they could pay a higher rate of interest on savings accounts. Unchecked interest rate competition between all types of banks had been allowed before the Great Depression, but was stopped afterwards as lawmakers thought it had allowed insolvent banks to attract capital. Despite this funding advantage, the thrifts still faced the built-in risk that interest rates would rise sharply and caused fixed-rate assets to yield less than the bank's variable-rate funding sources. Under Louis Vincenti and then Charlie Munger's leadership, mutual savings had seen this risk and sought to avoid it. Others attempted to grow their way out through ever-increasing amounts of loans funded by ever-increasing deposits. When their balance sheets became stretched, meaning assets grew faster than equity and the ratio of equity to assets fell, they petitioned and received legislation to decrease required equity levels. Much changed during the 1980s that caused trouble for thrifts. Inflation and the related rising interest rates led to large losses. The thrifts first lost their funding advantage through competition to money market funds, and then in 1986 to other banks when the Congress eliminated interest rate caps and allowed deposit competition among banks and thrifts. To make things worse, the managers of the thrifts had every incentive to push the envelope into riskier assets since the government was effectively subsidizing the interest rate costs by providing deposit insurance. The result was a runaway feedback mode of the negative sort, said Munger. He described it as a new form of Gresham's law, bad behavior drives out good, where bad lending drives out good. Accounting allowed losses to be delayed or temporarily covered. The system incented growth to average higher-yielding new assets with lower-yielding existing portfolios, and insolvency caused managers who had nothing on the line personally to risk it all like a desperate gambler trying to make up losses by doubling down. The system naturally attracted risk-takers, crooks, and other helpers, such as brokers paid to bring in deposits necessary to fund the expansion of assets. These brokers were shopping around with the government's credit, to borrow a phrase from Munger. Munger derided the United States League of Savings Institution, an industry lobbying association which combined a blind loyalty to silly ideas with a blind loyalty to member associations. In a portent of what was to come, Munger wrote, "If the League does not act more responsibly in the future, mutual savings will resign." Munger thought the FSLIC was doomed and that its insolvency would result in a combination of some or all of higher deposit premiums, higher equity requirements, curtailed investment options for thrifts, limits on growth of deposits, tougher accounting, quicker closure of questionable institutions, more regulation and oversight by Congress, a moratorium on new charters and/or new overall state and federal banking laws. He saw the need for such reforms but knew it was probably wishful thinking given the politics of the situation. Finding investment opportunity when others face adversity is a defining characteristic of Berkshire Hathaway. In 1988, this was on display with mutual savings investment in Freddie Mac, a hybrid operated by Federal Home Loan Bank Board and owned by private investors. Freddie Mac's business was simple. It purchased housing mortgage loans from originators and packed them into securities that it guaranteed and sold. It earned a fee and spread while avoiding interest rate risk. This was an essential financial function for the economy, and its owners could earn returns on equity north of 25%. Munger laid out his and Buffett's investment thesis. They were willing to do so because they had hit the maximum they could otherwise legally purchase. Munger wrote that given Freddie Mac's connection with government, its securities were perceived as having government backing. This gave Freddie Mac an enormous advantage. Between 1985 and 1988, this advantage was reflected in a return on equity ranging from the high 20s to 30%, an indication of a very good business. Perhaps due to its recency and vividness, some thought the same bureaucrats that ruined the FSLIC would cause Freddie Mac to suffer through mismanagement or through unfair dealings with owners. But the institutions and regulators were different. Munger considered the risk unlikely, at least for the time being. He also thought that investors generally had a lack of familiarity with Freddie Mac. The fact that the shares were trading around $50 per share compared to the $30 per share purchase price was an indication of correct investment thesis, at least for the time being. Financing. Comments on a new $250 million issue of debt that closed in early 1988 demonstrated the subtle yet powerful logical reasoning of Buffett and Munger. Counterintuitively at first glance, Buffett borrowed the $250 million with nothing in mind to do with the money. This meant the loan was costing Berkshire money up front. Berkshire borrowed at 10% and then reinvested it at 6.5% while waiting for good opportunities to come along. The cost of this waiting, about $160,000 a week. Why would Berkshire borrow money when the only prudent investment was below its cost? Unlike many in the business world, we prefer to finance in anticipation of need rather than in reaction to it, Buffett wrote. The rationale was clear-cut. A business's assets and liabilities can be managed separately, so why not focus on maximizing each independently to get the highest possible return on assets and the lowest possible cost of liabilities? Reason tells us that the best time to buy assets or acquire companies and the best time to borrow money rarely coincided exactly and are often exactly opposite, Buffett said. Therefore, action on the liability side should sometimes be taken independent of an action on the asset side. Though expensive on the surface, Buffett said if Berkshire found the right sort of business within 5 years, the wait would have been worth the interest paid on the debt. New York Stock Exchange listing. Berkshire's shares began trading on the NYSE on November 29, 1988, after the exchange agreed to allow Berkshire to be measured in 10-share round lots instead of the usual 100. In a letter to shareholders in August that year and reiterated in his chairman's letter, Buffett told shareholders that the primary reason for the listing was not to maximize Berkshire's share price. Instead, he and Munger wished to reduce transaction costs for shareholders. The listing allowed shareholders to buy or sell without the hidden tax of high commissions and wide bid-ask spreads. Providing this environment would let shareholders prosper alongside business results, not suffer share price gyrations unnecessarily. In short, they wished it to operate more like a private business with infrequent turnover in shareholders and a share price that tracked intrinsic value more closely. The NYSE listing also brought with it a requirement to add another independent director, since only Malcolm Chase Jr. met the test. To meet the requirement, Berkshire added Walter Scott Jr., CEO of Peter Kiewit's Sons Incorporated, an Omaha-based construction company, to the board. David L. Dodd. Buffett concluded his 1988 letter to shareholders with a eulogy of sorts to David Dodd. Dodd, the behind-the-scenes investment partner of Benjamin Graham and co-author of Security Analysis, died that year at 93 years old. Buffett fondly remembered Dodd's friendship and tutelage and praised his teaching of simple, sound, useful, and enduring investment principles. Paying Dodd the highest compliment, Buffett wrote that Berkshire's prosperity is the fruit of their, Dodd and Graham's, intellectual tree. The first 25 years, 1965 to 1989. Having just covered the mistakes of the first 25 years, it is worth taking a moment to put into perspective the incredible change in Berkshire during Warren Buffett's control. The Table 5.19 tells a compelling story. While a change in any individual year was smaller or focused on a few things, taken as a whole, those changes collectively transformed Berkshire Hathaway into an economic powerhouse. It is also instructive to take a closer look at how that 23.8% compounded annual return of book value was created. Beginning with just $22 million of equity capital in a self-described subpar textile business, Berkshire Hathaway was transformed completely. Over 25 years, shareholders' equity grew to $4.9 billion. The sources of that increase were roughly 48% from unrealized gains on marketable securities, 30% from operating activities, the wholly owned subsidiaries plus dividends and interest from investees, 19% from realized gains on marketable securities, and 3% from the addition of diversified retailing and blue-chip stamps during the 1975 to 1984 decade. A very small change was due to dividends, treasury stock transactions, and miscellaneous. Taking apart the 25 years, we can see how Berkshire earned its gains over that time. The first 10-year period, 1964 to 1974, was largely driven by operating activities. During the next decade, 1975 to 1984, the contribution of operations to book value growth shrunk to one-third of the total change, with over half coming from a combination of realized gains and unrealized gains on appreciation of investments. It was in this decade that saw a meaningful portion of the change in net worth come from the addition of diversified retailing and blue-chip stamps, both of which merged with Berkshire. The change during the 5-year period from 1985 to 1989, while shorter than a decade, nonetheless illustrates the continued shift towards the importance of the marketable securities portfolio. During that 5-year span, almost 3/4 of the change in Berkshire's book value came from realized or unrealized appreciation of investments, with unrealized appreciation accounting for a full half of the change. Chapter 7, 1990 to 1994. 1990. While the first 25 years of Berkshire Hathaway under Warren Buffett's control ended on a high note, it began lackluster, and the next 25 followed that pattern. Book value grew just 7.3% in 1990. The Berkshire of the bygone era was a textile business with dim prospects, while that of 1990 featured a conglomerate with much potential. The off year in 1990 was largely caused by Berkshire's significant common equity portfolio, which made up over half of its average assets and fluctuated along with changes in the overall stock market. While the current rate of book value growth was well below Buffett's goal of 15% per annum, Berkshire's businesses continued to be exceptional, and with most of those businesses making good progress during the year. Look-through earnings. The annual change in Berkshire's book and market values could swing wildly from year to year and diverge significantly from each other. See Table 5.23. This was because accounting obscured important information about Berkshire's economic earning power. Capital Cities ABC was an extreme case. In 1990, Berkshire owned 17% of the company. Berkshire's share of its 1990 earnings was over $83 million, yet Berkshire only recorded income of $600,000. Why? Because Cap Cities paid Berkshire $600,000 in dividends, and accounting conventions only counted those, completely ignoring the roughly $82 million that Cap Cities retained for reinvestment on Berkshire's behalf. Many of Berkshire's other investees had similar, though not so extreme, disparities. If those companies continued to do well, their underlying earning power would eventually translate into corresponding gains in market value. The solution for this accounting problem was look-through earnings. See Table 5.24. Look-through earnings accounted for retained earnings and adjusted for the taxes that would have been due if paid as dividends. The total for 1990, $591 million. It was an approximate figure to be sure, though one more closely aligned to economic reality. Manufacturing, publishing, and retailing. Berkshire's non-insurance economic engine continued to impress. Taken as a whole, the group contributed $216.8 million pre-tax to Berkshire's earnings in 1990, representing a pre-tax return on average tangible capital of 73% and equity of over 83%. The after-tax return on tangible equity was an equally impressive 51%, and importantly was achieved with no net debt. Such high returns on capital were scarce, and there were few incremental growth opportunities available within the subsidiaries themselves. As a result, most funds were sent to Omaha for reinvestment. In fact, over 80% of the manufacturing, publishing, and retailing business's earnings were sent to the parent company over the prior 5 years. Amid weak economic conditions, the U.S. entered a recession in 1990 marked by hundreds of bank failures. Borsheim's turned in revenue growth of 18% from one store, which Buffett estimated to be the largest after Tiffany's New York City location. The Friedman family continued to operate from a simple and effective playbook. They maintained rock-bottom operating costs, which produced a positive feedback loop from low prices, driving additional demand. This kept operating costs as a percentage of revenue low. It was the Nebraska Furniture Mart playbook, only for jewelry. Such low prices attracted shoppers from far beyond Omaha. The store had grown outside its physical footprint with a mail order service that shipped assortments of pieces valued at upwards of $100,000 to all over the country, counting on people's honesty to pay for them or return them. This seemingly risky business had yet to produce a loss from customer dishonesty. Nebraska Furniture Mart continued its relentless progress. Revenues grew 4% to $159 million in 1990 by attracting shoppers from far and wide. Profits ticked up 1% to $17 million. Nebraska Furniture Mart ranked number 3 in popularity in Des Moines, Iowa, which was 130 miles away, the equivalent of driving from Washington, D.C. to Philadelphia. It outranked 17 stores closer to Des Moines. Its low prices, like those of its sister company Borsheim's, created an irresistible magnet that lured shoppers from far outside a traditional market radius and allowed Nebraska Furniture Mart to maintain even lower prices by avoiding opening additional stores. Taking advantage of Nebraska Furniture Mart's popularity, Sears had a cart in the Omaha store. In what Buffett termed a counter-revelation against his dislike of the term synergy, this cart did more business than some California-based standalone stores. These successes, coupled with a 5% price increase, led to Sears' increased pre-tax profits nearly 16% to $39.6 million. This was despite a Christmas season that fell slightly below the mark. Reporting on the Buffalo News, Buffett wrote that the business showed far more vulnerability to the early stages of a recession than has been the case in the past. He openly questioned whether the paper's 5% decline in pre-tax profits to $44 million was temporary or an indication of a permanent situation. The relative weakness was also a window into the impact alternative advertising channels were having at two of Berkshire's major investees, Capital Cities ABCs and the Washington Post. Berkshire and the Buffalo News remained committed to its customers, however. Buffett wrote that it would not deviate from providing the quality of news that led it to success in the first place. Regardless of earning pressures, we will maintain at least a 50% news hole. Cutting product quality is not a proper response to adversity. At Fetchheimer, pre-tax profits grew just 4% to $12.9 million. Fetchheimer continued to have excellent prospects. It moderated or solved some of the issues that its large 1988 acquisition had thrown up. Still, amid a recessionary environment, the fact that it grew revenues and profits was a meaningful achievement. Scott Fetzer, under the leadership of Ralph Shea, turned in a result that would have placed it near the top of the Fortune 500 based on a return on equity. Pre-tax earnings came in at $101.9 million. Scott Fetzer's finance businesses earned a record $12.2 million pre-tax in 1990. Pre-tax earnings from its World Book unit increased 25% to $31.9 million, despite lower unit sales. At Scott Fetzer's Kirby unit, the new Generation 3 vacuum cleaner was an unqualified success. Costs with the new product introduction kept earnings down temporarily, but increased unit volumes and strong international demand portended strong results for 1991. Campbell Hausfield, a Scott Fetzer subsidiary and a producer of small and medium-sized air compressors, earned a mention in the 1990 Chairman's Letter for its particularly fine year. Insurance. Weakness in pricing continued to be the story in insurance, though Berkshire did find a way to put its reputation and capital base to profitable use in 1990. Berkshire's primary group wrote and earned almost 20% lower volume, totaling $139 million for premiums written and $154 million for premiums earned. The primary businesses continued to ignore volume for its own sake and remained focused on profitable underwriting. In one such example, premium volume in the New York City office fell from a high of $93 million in 1987 to just $18 million in 1990. The combined ratio for the primary businesses at 103.3% benefited from a fourth consecutive year of favorable loss development. Expecting a trend like that to continue was dangerous since it could be decades before all cases were settled. The real story in the insurance group in 1990 was the reinsurance division. Having written just $66 million in 1989, the reinsurance group wrote $384 million in 1990, multiples of the year before. The large increase in premiums was driven by $378 million on 1990 volume related to insuring large risks. Considering the volatility inherent in such business, Buffett took pains to explain the logic. He said that while volume in other lines continues to be small but satisfactory, Berkshire was pursuing business in the supercat, short for a super catastrophe, area of reinsurance. This line of business reinsured other insurance companies for large losses from natural disasters, typically above a predetermined threshold of loss for the primary insurer, no different than a deductible. The advantage Berkshire brought to this arena was both its willingness to write large policies and its financial strength. The latter was less important to consumers, but all important to large buyers of reinsurance. For the right price, Berkshire was willing to concentrate risk rather than lay it off. Profits were expected over time, but they came at the expense of volatility. For this segment alone, the combined ratio could be zero in some years, or as high as 300% when earthquakes, hurricanes, and other natural events struck. Measured over a period of a decade, Buffett thought that Berkshire's overall results would be better than insurers who preferred to lay off the risk to others in exchange for smoother sailing. He summed it up nicely. Charlie and I have always preferred a lumpy 15% return to a smooth 12%. Buffett's basic framework in how he thought insurers should be measured was the cost of float. This was determined based on a ratio of underwriting loss to average float. In this way, the cost of float, assuming a combined ratio over 100%, was akin to the cost of debt. Comparing the cost of float to an interest rate benchmark would provide a gauge for the quality of float generated. Most insurers could still produce a break-even result with a cost of float between 7% and 11%. Under long-tail situations where a long time period elapsed from premium collection to the payout of losses, a higher combined ratio of 115% or more could be profitable. Berkshire first entered the insurance industry with the purchase of National Indemnity in 1967. Between 1967 and 1990, Berkshire underwrote to a profit in half of those years. See Table 5.26. This meant its cost of float was negative. In 7 additional years, its cost of float was below that of long-term U.S. government bonds, meaning the insurance group was borrowing at a cost lower than the U.S. government. In the remaining 5 years, Berkshire's cost of float was higher than the long-term government bond. The worst year was 1984 with a differential of 7.4 percentage points. In short, Berkshire generated a large and growing amount of float at an attractive cost. In 1990, Berkshire's $1.6 billion of float cost it just 1.6%, far below the 8.2% cost incurred by the U.S. government. Keying shareholders into his thoughts on valuation, Buffett wrote that the insurance group intrinsic value was worth far more than its carrying value. Even though its variability in results caused the intrinsic value of Berkshire's insurance operation to be harder to value than the non-insurance businesses, it was, he said, the one with the greatest potential. Investments. Given the Berkshire philosophy of viewing common stock investments as equivalent to ownership of entire businesses, it came as no surprise to see little activity in its holdings. That was the case in 1990. As Buffett put it, lethargy bordering on sloth remains the cornerstone of our investment style. This year we neither bought nor sold a share of 5 out of 6 major holdings. This meant there was no trading activity for Capital Cities ABC, Coca-Cola, the most valuable franchise in the world according to Buffett, Freddie Mac, Geico, or the Washington Post. The only real activity in the equity portfolio in 1990 was purchasing Wells Fargo shares. While Berkshire began buying shares the year before, it was not disclosed anywhere in the annual report since very few shares were acquired in 1999. By the end of 1990, Berkshire had acquired 5 million shares at an average cost of under $58 per share, or about $290 million. This was equivalent to 3 times pre-tax earnings or 5 times after-tax earnings. Berkshire's ownership was equal to 10% of Wells Fargo. The way Buffett described it reflected his attitude toward buying a portion of any business, public or private. Berkshire's Wells Fargo stake was roughly equivalent to Berkshire buying 100% of a $5 billion bank. Wells Fargo had about $56 billion of assets at the time. While Buffett and Munger were not big fans of the banking business due to the risks inherent in a highly leveraged enterprise, the quality of Wells Fargo and its manager, Carl Reichardt, coupled with the attractiveness of its share price, presented a worthwhile investment opportunity. Wells Fargo had recently fallen over 50% in a short period due to concerns that a real estate bust tied to the recession would cause large losses at West Coast banks. Buffett's rational logic explained his reasoning for why Wells Fargo would fare just fine amid the landscape of bank failures nationwide. Consider some mathematics. Wells Fargo currently earns well over $1 billion pre-tax annually after expensing more than $300 million for loan losses. If 10% of all $48 billion of the bank's loans, not just its real estate loans, were hit by problems in 1991 and those produced losses, including foregone interest, averaging 30% of principal, the company would roughly break even. Such a low-level possibility event, wrote Buffett, would cause Wells Fargo to report no profit that year and then go on earning 20% on growing equity. The fixed maturity portion of Berkshire's investment portfolio saw few changes in 1990. Berkshire increased its holdings of RJR Nabisco bonds to $440 million, but avoided other below-investment-grade issues. Even though the logic of acquiring junk bonds as a portfolio was sound if purchased at the right price, Wall Street had characteristically taken the idea too far. There was a key difference between the bonds of former investment-grade companies such as RJR Nabisco, which were downgraded, and those that originated as junk bonds. The former had managers who worked to regain the company's investment-grade status, while the latter had no benchmark to guide their behavior. Though he was writing about the savings and loan industry, Charlie Munger's label of knaves and fools would have done well for a description of some of the junk bond company managers and their Wall Street brethren pushing them at the time. Buffett used a similar term, financiopath. There was some mixed news on Berkshire's 4 major convertible preferred stock issues. The $700 million Solomon issue and the $300 million Champion International issues were performing as expected. The U.S. Air issue was likely worth substantially less than the $358 million purchase price. The airline was struggling due to continued industry weakness and integration problems with another airline it purchased. Berkshire's $600 million of Gillette Company convertible preferred, though worth somewhat more than it had paid, was about to go away. The issue had been called, and as a result, Berkshire would receive 12 million shares of Gillette on April 1, 1991. Berkshire would give up over $50 million of annual preferred stock dividends, but it would continue to hold a nearly equal asset in its claim to 11% of Gillette's earning power. Wesco. The savings and loan crisis was a slow-moving financial disaster that began in 1986 and ended a decade later with about a third of savings and loan institutions out of business. With an additional time to study the issue, Munger used 10 pages of his Wesco's chairman's letter to provide excellent observations as to why Wesco didn't fall for the tactics that led to bank failures. Munger wrote out of overwhelming disgust with the present scene and was inspired by a long association to an eccentric fellow, Buffett, who encourages this kind of writing. Munger said the cause of the savings and loan crisis was a confluence of events. One issue was government-provided deposit insurance, which effectively allowed bankers to use the government's credit to obtain low-cost funding. Related to that was a structural weakness in that short-term sources of funds were used to finance long-term assets, creating interest rate risk. A weak regulatory structure allowed a bank to shop for its regulator, and this caused a lowest common denominator effect where the weakest banks were attracted to the easiest regulator. Then came deregulation of interest rates and low overhead money market funds. This caused a higher cost of funds for all banks, thrifts and commercial banks. That in turn produced the natural effect of riskier lending as banks needed higher yielding assets to cover their higher costs. Some banks even went so far as to advertise a willingness to fund a portion of consumers' vacations among other risky lending activities. Banks were not alone in risky lending. The 1980s heralded the invention of large-scale original issue junk bonds purchased by the likes of Michael Milken. Before the 1980s, few people issued junk bonds. They became common in the early 1980s as a way for young companies with no credit to issue bonds and get early funding. This practice came to a temporary halt at the end of the 1980s as default rates rose, though it did return in future decades. Munger's analysis started with a question. How then does bad lending occur so often, he asked. The answer, he said, was because humans are social animals with predictable irrationalities. This leads them to follow the crowd and copy bad behavior. The effect of such folly was predictable. Many bank insolvencies will come. He was right. By 1995, over 1,000 banks were out of business. Munger offered a possible solution, or at least mitigation of the above deficiencies. One solution was significantly reducing deposit insurance. Quite the opposite of shoring up the weak deposit system, Munger wrote that additional deposit insurance might weaken it since it raised banks' costs above those of money market funds, which paid no deposit insurance. His other ideas included the elimination of money market funds via legislation or bringing back interest rate controls, both of which were technically possible but unlikely. Still, other ideas which could be used alone or in combination were forcing weak banks to close or merge with local or non-local banks. Banks that closed should do so before they became insolvent. Munger thought it bonkers that regulators would wait until the very end, at which point large losses to the deposit insurer were almost guaranteed. Another option Munger proffered up would affect the accounting of banks and their brethren. He thought discussions of accounting were not focused on the right area. Discussions centered on how to delay loan write-offs via accounting maneuvers. Munger felt this created poor incentives for bank managers to front-end interest and free income from loans, especially with new classes of risky loans having as yet to be determined loss characteristics. This encouraged lending to riskier borrowers since income could be booked immediately that might ultimately have to be reversed. Munger called this reality denial and believed much more conservatism was needed to begin with. Munger's system would be more like insurance, in which future losses would be estimated up front using logical and conservative methods and then corrected as time went on. He thought offering a carrot in the form of tax savings in addition to the regulatory sticks would incent the right behavior on the part of managers and boards of directors. Toward the end of the 1990 Berkshire Hathaway chairman's letter was the familiar advertisement seeking acquisition candidates. Buffett augmented his usual plea by including as an appendix a 2-page letter written to an owner considering selling to Berkshire. The business was not named. Entitled Some Thoughts on Selling Your Business, Buffett's letter went through the advantages of selling to Berkshire. It was also candid. You would be no richer after the sale than now. A sale would, only, change the form of your wealth from 100% of one business to cash and investments in other businesses. The letter offered some insight into Buffett's thinking on acquiring family-built companies. Although Berkshire would adapt to sellers' methods rather than vice versa, he had a few stipulations. One was that he preferred the selling family maintain a 20% ownership interest. This put Berkshire's ownership at the 80% level needed for tax purposes. More important, it maintained the proper alignment of incentive so Berkshire could be hands-off. The areas I get involved in are capital allocation and selection and compensation of the top man, he wrote. The letter was another key policy that helped avoid ballooning compensation costs, given that just about all other decisions would be made at the operating company level. Finally, Buffett informed shareholders that Ken Chase had decided to step down from the board. Buffett's wife, Susan, would be nominated to succeed him. An informed board member, she had the second largest ownership stake in Berkshire after her husband and shared his views on succession and preserving the Berkshire culture he so painstakingly put into place. 1991. Berkshire Hathaway's book value shot up 39.6% in 1991. Like the previous year, which saw an increase of just 7.4%, the current year was heavily influenced by Berkshire's large investment portfolio. Of the $2.1 billion gain in book value in 1991, over three-quarters of it, or $1.6 billion, was due to appreciation of just two stocks. the recently purchased 7% interest in Coca-Cola, and newly converted shares in Gillette. Against a backdrop of a general recession in the United States in 1991, Berkshire's operating companies did well, though less well than the year before. Pre-tax operating earnings fell 17% to $401 million. Berkshire also found a new operating company to buy in H.H. Brown Shoe. Also, Warren Buffett reluctantly found a second job running and saving Salomon Incorporated. The story of Buffett's interlude running Salomon is a cautionary one and well worth the effort to study in full. Berkshire first purchased a $700 million convertible preferred stock issue from Salomon in 1987, which put Buffett and Charlie Munger on its board to represent Berkshire's 12% voting interest. Several years went by without a problem. Then in mid-1991, news came to light that one of Salomon's employees had broken the law by abusing Salomon's privileges as a primary dealer in U.S. Treasury securities when he improperly used customers' accounts. The fact that Salomon had committed the transgression wasn't the real sin. The real problem was CEO John Gutfreund knew about it and did not tell the government. The series of events which followed are like a Greek tragedy. The Salomon employee set the scene by committing the crime more than once during the beginning of 1991. Salomon's management made it a tragedy by not reporting the wrongdoing to Salomon's regulator, the New York Federal Reserve Bank. The general counsel took the matter to his boss, CEO John Gutfreund, who did nothing, precipitating his own downfall. Gutfreund believed it would either go away or at worst result in nothing more than a slap on the wrist. This was a fatal error of judgment. Instead, the situation blew up as Gutfreund not only failed to inform the government of Salomon's violations of the law, but also didn't inform Salomon's board, including Buffett and Munger. What happened next was a run on Salomon as its creditors rightly assumed it could fail if the government stopped doing business with it. Gutfreund found himself out of a job, and Buffett found himself chairman of a teetering investment bank. He explained it this way. In 1989, when I, a happy customer of 5 cans of Cherry Coke daily, announced our purchase of $1 billion worth of Coca-Cola stock, I described the move as a rather extreme example of putting our money where my mouth was. On August 18th of 1991, when I was elected interim chairman of Salomon Incorporated, it was a different story. I put my mouth where my money was. What followed was a heroic, nearly 10-month-long rescue mission that stretched into 1992. Buffett feared that many innocent Salomon employees would lose their jobs. He feared for the entire financial system given Salomon's deep ties to the financial world. He also feared for his own reputation. So Buffett pleaded with government officials to maintain Salomon's status as a dealer in treasuries and not shut down the bank. At the very last hour, he was successful. If Buffett had been unsuccessful, the firm surely would have failed. Instead, Buffett risked his well-earned reputation to save Salomon and then handed off the reins to Derek Morgan, an insider with deep knowledge who could credibly claim innocence since he was stationed at the firm's Tokyo office at the time. The Salomon episode would later burnish Buffett's reputation, not just because he had saved the firm. His forthrightness and honesty, including waiving attorney-client privilege during investigations, set a high bar and showed how a crisis should be managed, made easier, of course, because he had no hand in the making of it. At every Berkshire Hathaway annual meeting, Buffett plays a clip of himself testifying at a congressional hearing. Lose money for the firm and I will be understanding. Lose a shred of reputation for the firm and I will be ruthless, is Buffett's now famous message. It is a message worth repeating. The other Salomon lesson was that Berkshire could operate fine without him. The Salomon stint did not impact Berkshire to any significant degree because Berkshire's managers were capable and in control. Still, Buffett was quick to point out the word interim in his new Salomon interim chairman title. Berkshire, he wrote, shareholders, is my first love and one that will never fade. Sources of reported earnings. Look-through earnings declined by 14% from $602 million in 1990 to $516 million in 1991. Both Berkshire's operating income and its share of investees' earnings contributed to the decline. Media companies Cap Cities ABC and the Washington Post suffered due to changing industry economics. Wells Fargo posted a loss that hurt investee look-through earnings, but which was offset by dividends received and counted toward Berkshire's operating earnings. Berkshire's largest operating division, insurance, recorded significantly lower but still excellent profits. Pre-tax operating earnings from insurance, including underwriting and investment income, dropped from $300 million in 1990 to $212 million in 1991 because of a large underwriting loss. A change in media economics and some valuation math. In a section of his chairman's letter so entitled, Buffett illustrated quite simply how media companies such as Cap Cities ABC, the Washington Post, and the Buffalo News had weaker performance than in years past. The discussion also included Buffett's thinking on the three types of businesses in the business universe. Type 1. The most valuable business, regardless of industry, was an economic franchise. Not to be confused with the more commonly known lease-a-concept business operation, Buffett defined a business franchise as one that 1. Is needed or desired, 2. Is thought by its customers to have no close substitute, and 3. Is not subject to price regulation. Such businesses, which included media companies prior to 1991 and might have included them then, had pricing power and earned high returns on capital. Also, they were largely immune to inept management. Type 2. A good business. Buffett was realizing that media companies were becoming less franchise-like and more akin to a good business. The only way for a business to earn high returns on capital was to be the low-cost operator. This was usually the result of an above-average manager. Media companies' valuations suffered as their operations faced a slide in quality. As a franchise, many media companies regularly grew earnings 6% per year without the need for additional capital. This pricing power provided solid earnings and returns on capital, but media businesses were losing their ability to price aggressively and be managed loosely as competition intensified and the companies lost some of their franchise strength. Quite understandably, investors priced them to suit. Assuming a 10% discount rate and 6% perpetual growth, such a business would rationally be worth 25 times earnings. But when that cost-free growth disappeared due to the shift in economics, favoring alternative forms of advertising, such a business would only be worth 10 times earnings. Such normal businesses could still be good investments, but they would require additional capital to grow. Buffett was trying to explain that growth was not some ethereal concept to be plugged into a model without thought. It took knowledge of how underlying operations worked. A business was usually restricted due to capital requirements. Growth could not be had unless more capital was put up through retained earnings, additional equity, or borrowing, or a combination of the three. Absent additional capital, Buffett said a bob-around pattern is indeed the lot of most businesses. Berkshire shareholders could look to Scott Fetzer, or more broadly the manufacturing, publishing, and retailing segment, to see that high returns on capital did not automatically come with growth. Buffett had noted in his 1990 letter that 80% of the manufacturing, publishing, and retail businesses' earnings were paid out as dividends to Omaha. This was okay since the underlying returns on capital were satisfactory. It just meant searching elsewhere for a place to allocate the excess capital above and beyond those businesses' needs. Type 3. Buffett did not discuss the third type of business, essentially everything other than a franchise or a good business. He presumed shareholders could figure that out for themselves. High-cost commodity operations and/or those requiring a lot of capital with no attendant growth would fall into this last category. Of those, there were many. Perhaps Buffett didn't want to discuss the poster child for such a business, Berkshire's own textile business of the prior decade. Insurance. The 30,000-foot view of the operating earnings summary showed the insurance group posting a large loss from underwriting, while positive earnings overall due to investment income. Insurance earnings were down significantly, but they were nonetheless excellent in context. The underwriting loss provided a cost of float of 6.3%, lower than the long-term government bond rate of 7.4%, and float grew 16% to an average of $1.9 billion. The insurance group was following a basic recipe for success: more float at an attractive cost. It is important to understand the impact of the type of premiums written by the insurance group and the related accounting conventions. Berkshire was moving into the greener pastures of supercats insurance, using its superior capital strength and willingness to write large policies to its advantage. The supercat business had the benefit of producing a lot of float, but it also came with risk and volatility in reported earnings. Such lines could cause a $100 million profit in a good year or a $200 million loss in a bad one. Berkshire priced the business to pay out 90% of premiums over the long term, which it thought would produce a profit over time. Accounting for supercats and other long-tail types of insurance was even more difficult than the primary or direct lines, and even those weren't easy. The nuances were important for shareholders to understand. Even in a good year where no supercat events occurred and Berkshire earned all its large $100 million annual premium volume, it was economically accruing risk and future losses that would, someday, be paid out as claims. Accounting conventions, however, did not allow for reserving for such near-certain future losses, and so reported results could swing wildly. Supercats were not the only possibilities for accounting confusion. The notes to the financial statements provided important accounting disclosures as there was potential for readers to be misled. Even though Berkshire had recorded yet another year of favorable loss development, including a full $30.6 million relating to the quota share reinsurance contracts previously shared with Fireman's Fund and others, there was still a chance for unfavorable development in future years. Berkshire was not immune to unfavorable surprises, but on balance, its financial statements usually exhibited elements of conservatism. One important disclosure for readers to be aware of was deferred charge amortization for retroactive insurance contracts. A retroactive reinsurance contract provides insurance for known loss events that are expected to extend into the future, but which a primary or other reinsurer wishes to lay off. Since claims come in the future, sometimes far into the future, and float is available for a long time to generate income to offset future losses, reinsurers appropriately accept premiums lower than the expected future payouts. The accounting for retroactive reinsurance contracts can cause some confusion if not properly understood. The day a contract is booked, the reinsurer receives an upfront cash premium. Since the earned premium is offset by losses larger than the premium received, the losses are split into two buckets. One is equal to the premium just received and expensed immediately as an incurred loss. Second, the day one excess of loss over the premium received is placed on the balance sheet as an asset. While somewhat counterintuitive at first, this accounting generally makes sense. In theory, this new deferred charge asset will amortize away via the expense account, offset by earnings from the investment income generated by the upfront cash received, hopefully with a small profit left over. While this theory is sound, it has the effect of causing apparent underwriting losses in future periods, as the deferred charge asset is expensed without any offsetting premium being earned. Remember, the entirety of the premium is earned day one, with the economics of the transaction based partly on the ability to generate investment income. In 1991, Berkshire disclosed $26.2 million of underwriting loss associated with such deferred charges on retroactive insurance. In addition, a $22.8 million underwriting loss was booked with respect to structured settlements. Structured settlements were also based on time value of money concepts and caused similar accounting issues like retroactive reinsurance. In short, the favorable economics of these contracts, holding cash for a long time, could be overshadowed by what looked like losses, amortization of the asset, due to the accounting. Manufacturing, publishing, and retailing. The manufacturing, publishing, and retailing businesses reported pre-tax earnings of $214.5 million, down 1% from the prior year. Revenues grew 4.6% to $1.65 billion, but also contained revenues from acquisitions, including H.H. Brown mid-year. Flat earnings seem unimpressive until translated into a pre-tax return on tangible capital of 57.2%. That result is impressive on its own, no doubt, but it fell from 73% in 1990. The cause? A recession and Berkshire's continued acquisition of very good but slightly less spectacular businesses. After-tax return on equity fell from 51.1% to 39.3%. Berkshire's history with See's Candies illustrates the economics of a wonderful business. When Blue Chip Stamps purchased See's in 1972, it was already a very good business. Its pre-tax return on capital was north of 50%. 19 years later, in 1991, See's was doing even better. Pre-tax earnings had grown tenfold, while the capital needed to operate the business had only tripled. The result? An explosion of profitability with a pre-tax return on capital in the triple digits. A truly mouth-watering result. With such large numbers, it was easy to conclude the growth of See's was a success. It was not as apparent with other businesses. Buffett laid out his analysis. For an increase in profits to be evaluated properly, it must be compared with the incremental capital investment required to produce it. Using this framework, See's required an investment of $17 million to increase earnings by $38 million, a wonderful return by any standard. How is this possible, especially given the frequent commentary by Buffett and Munger that the industry was very tough? The answer was the company's untapped pricing power. Said another way, its customers were not overly price sensitive. This was evident in the fact that 1991 results were better even in the face of a new tax on snack food. Same-store poundage fell 5%, but pre-tax earnings increased 7% to $42.4 million. Lower cost inflation helped to cause that result, but See's was still an excellent business. The $410 million of earnings distributed to blue-chip Berkshire Hathaway by See's over the prior 2 decades was sweet, but the company brought something else that was perhaps more valuable. The lessons learned from See's made Berkshire significant money by teaching Buffett and Munger the advantages of owning great businesses. H. Brown Shoe. Berkshire's latest acquisition was H. Brown Shoe Company, the leading North American manufacturer of work shoes and boots at the time. Buffett reported that the Massachusetts-based business earned fine margins on sales and assets. It was founded by Ray Heffernan and later run by his son-in-law, Frank Rooney. After Heffernan's death, the family decided to look for a home for the business and found one in Berkshire. Like many other Berkshire subsidiaries, Rooney had no monetary need to work but continued to do so because he loved the business. The H. Brown acquisition put Berkshire on a path back to manufacturing, this time in the shoe business. New England was a hotbed for shoe manufacturing in the 1970s. There were 1,100 shoe manufacturing plants in the U.S., but by 1985, only about 500 remained. The decline in American shoe manufacturing employment was in full force in 1991. This may sound ominous, and the factors just described probably played a part in the price Berkshire was willing to pay. H. Brown's unusual compensation program warmed Buffett's heart. Company managers were paid an annual salary of just $7,800, with the remaining compensation coming from a percentage of profits after a capital charge. These managers, therefore, truly stand in the shoes of owners, wrote Buffett. The business joined Berkshire on July 1, 1991, and earned $13.6 million pre-tax for Berkshire that year. Nebraska Furniture